Michael Burry just revealed what mainstream media is calling a massive bet against the stock market, but in reality, there's a bit more to it than that. Burry, who has been radio silent since deleting his Twitter account earlier this year, has just released his Q2 13F filing, and in it, we see two notable options bets against the stock market. On first glance, it reads that he's opened two massive put option positions against both the S&P 500 and the Nasdaq 100 worth $887 million and $739 million respectively. And although this is a bet against the market, the truth is the media and the Twitter community have really blown this one up much bigger than it deserves to be. Because in reality, his bet is probably reasonably small, certainly nowhere near as large what the headlines are suggesting. You see, put options give the holder the right to sell shares at a predetermined price, called the strike price. Thus, if I bought a put option with a strike price of $10, I would want the share price to fall below $10 because then I can buy the shares on the open market for less and sell them to the investor that wrote me the put option for $10. The share price fell to $6, I have the right to sell to this investor for $10 and I pocket $4. That is exactly what Michael Burry has done with the S&P 500 and the Nasdaq 100. He's bought put options off another investor, and to make money, he needs the value of those ETFs to fall below his strike price. But here's the thing. He has not bet over $1.6 billion on these indices falling. This number represents the total market value of the number of shares he bought put options against. In reality, put option contracts cost a heck of a lot less to purchase than the stock itself. So no, he's definitely not made a $1.6 billion bet against the market. His 13F confirmed he bought put options against 4 million shares, 2 million each against SPY and QQQ, which means in total he's bought 40,000 put option contracts, as each option contract represents 100 shares. But here's the thing, if we log on to Yahoo Finance and look at the put option contracts with expiry dates roughly a month from now, depending on the strike price, we see like a cost of 30 cents per share, $1 per share, $6 per share. That's a lot lower than the share price of SPY, which is currently sitting around $450 per share. So with that said, how much did Michael Burry bet against the market? Well, unfortunately, the reality is we simply don't know. The reason we don't know is because the only thing that gets reported is how many option contracts he ended up buying and whether they were puts or calls. What we don't get is information around what the strike prices were or even the expiry dates. And without getting too into the weeds, those two factors greatly influence the price the put option will cost to buy. The closer the strike price is to the current share price, the more the option will cost because it's more likely to work out in the buyer's favor before the expiration date. And along that same line of thinking, the longer the option's expiry date, the more the option will cost because there's more time for the conditions to come to fruition. So with this in mind, Michael Burry could have done a range of things. He could have spent a small amount of money making a bet that the market will fall a lot, or he could have made a much larger trade betting that the market will fall a little. Or of course, there's nothing to stop him from doing a mix. And on top of that, we don't even know what time frame he's betting on it happening. Unfortunately, when it comes to options reported in the 13F, there's simply not enough data given to us for us to conclude anything beyond the fact that Michael Burry is indeed making some sort of bet where he'll make money if the S&P 500 and the Nasdaq 100 fall in value. And here's the other thing, as is usually the case with Michael Burry, it's hard to take away any strong conclusions from his 13F because he's proven time and time again that while he has the brain of a value investor, he does like to make short-term trades. He isn't the same buy and hold investor like a Warren Buffett or a Charlie Munger. In fact, he dances in and out of the market so much that because the 13Fs get held for 45 days after the end of the quarter, we can't even be sure he still holds these put option positions. It very well could be the case that he's already sold out of them and moved on to something else. And the same goes with the changes he's made to his equity portfolio. So with that said, let's now talk about that equity portfolio. And this is where the plot thickens because while he's betting that the S&P 500 and the Nasdaq 100 will fall, he's also gone ahead and added a lot of individual stocks to his portfolio. So make sense of that. He added 25 new stocks, added to 3 existing positions, then he reduced 3 positions and he sold out of 15. That is quite the portfolio turnover. And if you notice, he's got almost the exact amount invested at the end of Q2 versus the end of Q1. So he's literally just subbed out a whole bunch of names and subbed in others. It very much looks like a trader's portfolio, right? And I've made this point before, but I'll make it again. Look at Warren Buffett's 13F history. Look at how consistent that is. He's obviously a long-term investor, right? Now look at Michael Burry's. Notice something? It's all over the place. The only consistent thing there is inconsistency. So take it all with a grain of salt. But with that said, why would Michael Burry seemingly contradict himself in the same 13F filing? He's bought 25 new stocks at the same time as betting the stock market is going to fall. Now, this one stumped me for a while until Hamish reminded me about the composition of the S&P 500 and the Nasdaq 100. Look at the weight of both of these indices side by side. Notice the biggest holdings, both of them, Apple, Microsoft, Amazon, Nvidia, Meta, Google, Tesla. These 7 businesses are what's now being called the Magnificent Seven. Why? Because they are responsible for a very large portion of the S&P 500's rally across 2023. And it all boils down to speculative hype around those big buzzwords, artificial intelligence. So I think in the case of Michael Burry's portfolio, what he's really doing is making a short-term bet that this stock market hype caused by AI isn't going to last. And if these 7 stocks run out of steam, because they hold literally 27% of the weight of the S&P 500, they could drag the entire market, and particularly the Nasdaq 100, down. But then on the flip side, he's still finding individual opportunities out there. Hence, he's added those 25 stocks to his portfolio. But with that said, what did Michael Burry do with his portfolio in Q2 2023? Well, the first big follow-up from Q1 is that he decided to exit the Chinese tech stocks he held, that of course being Alibaba and JD.com. These 2 stocks comprise 20% of Scion's US stock portfolio at the end of Q1, and they're actually his top 2 largest positions. At the time, I speculated that there was actually decent potential for these positions to stick around, as both stocks had managed to stick around in the portfolio across multiple quarters, and he did have prior dealings with both. But, well, that clearly was not to be, right? He likely would have still made money on this bet though. JD would have most likely been roughly break even for him, as it was sitting around its 2022 low price in the second quarter. And on the Alibaba front, it's likely he made a good chunk of change, with the shares rising as much as 60% higher from their Q4 low in Q2. So that seems to be it for the Chinese tech stocks. And another story we saw from his sales was that he closed out his position in the US regional banks. Of course, we know the US regional bank stocks got absolutely crushed earlier this year, as we saw a few dominoes start to fall thanks to depositors withdrawing funds. But there's no doubt this caused a lot of fear in bank shares, fear that Michael Burry took advantage of. But with the unpredictable and volatile nature of bank runs, he didn't just make a bet on 1 or 2 regional banks, he made a basket bet on a few. Those names included PacWest, First Republic, Huntington Bankshares, New York Community Bancorp, and Western Alliance. Smart in theory, although it looks as though his results would have been fairly mixed on this bet. Of course, we know First Republic definitely didn't work out, but he also would have likely lost money on Huntington Bankshares, while likely being roughly break even on Western Alliance, and probably making money on PacWest and New York Community Bank. So definitely a mixed bag, but he has decided to wrap that up and move on. And with that said, there were also a few notable buys this quarter as well. Notably, Burry bought into 2 travel-related businesses, that being Expedia and MGM Resorts International. Expedia operates a few different online travel brands, including Expedia, obviously, as well as Hotels.com, Vrbo, Orbitz, Travelocity, eBookers, and What If. And interestingly, Expedia is now the largest holding in Burry's portfolio at 9.82%, worth around $11 million. He also bought MGM Resorts International, which is a global gaming and entertainment company that owns 17 US-based casinos, has a 56% stake in MGM China, and owns online gambling site Leo Vegas. I mean, if you've ever been to Vegas, chances are you've donated more than a few dollars to MGM Resorts. Then beyond these 2 businesses, Burry also made significant investments in Charter Communications, Generac Holdings, and CVS Health. And one note that I picked up from Unrivaled Investing's recent video on Michael Burry's 13F is that many of these businesses trade at really quite low price to free cash flow multiples. So it shows you that Michael Burry is still very much in that value mindset, albeit being a very short-term focused investor. Expedia and CVS both have price to free cash flow multiples of 7, Charter's at 10, but going down the list further, you also have Stellantis at 5, Vital Energy at 4, Warner Brothers at 9. As is the case with Michael Burry, while he might be a little bit too much of a short-term focused investor for my liking, he still does have that classic value mentality. And a lot of these stocks are what you would call classically quite cheap. But of course, as I said earlier, I don't think there's too much more we can take away from this information besides maybe using it as a bit of an ideas list for some businesses that could be worth us looking into ourselves. But with that said, guys, that is Michael Burry's 13F filing for Q2. Definitely let me know what you think down in the comments section below. If you like this video, please leave a like on it and subscribe if you'd like to see more. But with that said, I'll see you guys in the next video.